page 156. We're going to be calculating variable cost, fixed cost, and preparing a contribution margin income statement. So, in the information given on page 156 for Cornerstone Exercise 413, they would like us to calculate the total variable cost per unit, the total fixed cost per unit, and prepare a contribution margin income statement for the head first company. Remember, in this chapter, we are segregating costs by how they behave, whether they're variable or fixed, rather than how we're classifying them previously as their product or period. So, when we're looking to calculate our total variable cost per unit, we are looking at any cost that is variable, whether that's direct materials, direct labor, overhead, selling, or an administrative expense. So, therefore, if we're looking at our total variable costs per unit, it would include direct materials, our direct labor, our variable factory overhead, as well as our variable selling expense. My direct materials were $30 per unit. My direct labor is $8 per helmet. The variable factory overhead per helmet was $4, and our variable selling expense, which is a commission for each helmet sold, was $3. We add all four components together to get our total variable cost per unit of $45. In part 2, we need to calculate our total fixed expenses. They tell us that our total fixed factory overhead, which we know is a product cost, is $20,000. They also tell us that our fixed selling and administrative expenses totaled $29,500. These are considered period costs, but again, they're both fixed, and that is what we're looking for in this example. Therefore, our total fixed expenses are $49,500. In part 3, they want us to prepare a contribution margin income statement. We calculate contribution margin by taking sales minus all of our variable expenses. A contribution margin shows how much money is left over to contribute to covering all types of fixed costs and hopefully providing for a profit. We start off our contribution margin income statement like we start off any other income statement, with the amount of sales revenue that we anticipate. They tell us that our sales are going to be 5,000 helmets, and we plan to sell them for $75 a piece. Therefore, we are anticipating for the coming year $375,000 in sales. We then want to subtract out all of our variable costs. Our variable cost per unit we know is $45 from what we had calculated in part 1, and again we plan to sell 5,000 helmets. A variable cost, remember, stays consistent on a per unit basis, in this example $45, but changes in total based on the level of output. Therefore, the more helmets we sell, the more variable cost we'll incur. So at 5,000 helmets, we will have a total variable cost of $225,000. To calculate contribution margin, we take our sales minus our variable costs. So in total, we have a contribution margin of $150,000 if we sell 5,000 helmets. And on a per unit basis, we have $30 in a contribution margin. We then need to subtract away all of our fixed costs to see if we will in fact make a profit. Our total fixed costs from what we calculated back in part 2 totaled $49,500. We subtract this away from our contribution margin to arrive at an operating income of $100,500.